So I don't know how many people would be sympathetic to this, but really, about 15, 20 years ago, so I'm a little bit older than I look, but 15 to 20 years ago, it was kind of universally believed that, sell-side research was not very valuable. So, the buy-side, big hedge funds in their arrogance, always believed that, it would be impossible for somebody on the sell side who's making research publicly available to a large number of clients to produce anything of value. And even in investment bank management, investment bank management felt, well, quant funds are really sensitive to transaction costs. They're never going to pay for quant research. So it is absolutely not an understatement that I can stand here and say that Yin Luo and his team single-handedly changed that worldview. So Yin's been the number one ranked sell-side quant researcher for a long time now, and he's not number one by a small margin. He's number one by a massive margin. So Yin joined Wolfe Research in September 2016 as a vice chairman to lead the coverage of quantitative research, economics, and portfolio strategy, which they call QES. Prior to Wolfe Research, Yin was a managing director and global head of quantitative strategy at Deutsche Bank. Yin started at Deutsche Bank in New York in October 2009, and in 7 years, as I implied, he built a world-class quantitative and macro research franchise. Yin has been the ranked number one in Institutional Investor Magazine, in II All-America Equity Research Survey and quantitative research for the past 6 years. And he's been top ranked as well in the accounting and tax policy and portfolio strategy sectors. Yin holds a Bachelor of Economics degree from Renmin University in China, a MBA in finance from the University of Windsor, and a Master of Management and Professional Accounting from the University of Toronto. So with that, I'm pleased to turn it over to you again.
And thank you for Faz and Kelly for inviting me to speak into this conference. Very excited to see a very large audience today. And luckily, my presentation actually works, so I don't need to play the computer science game. So my talk was really about something I thought is quite interesting, where, as you know, so the vast majority, although as both quant and fundamental research, I actually started my career as a fundamental research analyst 20 years ago. So unlike most of the conventional quant, I went through a very different route of doing quant research. Right, so we mostly traditionally been focusing on what we call structured data, meaning financial statements, market data. So any sort of a data we can easily map into an entity, either in the equity world or in the multi-asset world. So we're mostly working with the numeric data instead of what we call unstructured data. And of course, in reality, the vast majority of the information is in a sort of unstructured format, meaning in textual, video, audio, or images type of data format, which, of course, traditionally wasn't quite easy to analyze. So that was sort of my talk. And again, just as a little background, as Johnson introduced, I won't do too much of a commercial. So the talk was really about how do we use sort of the latest both information technology, but also in terms of analytical algorithms, natural language processing, machine learning, in the sense of analyzing unstructured corporate filing data. Machine learning, of course, has gained tremendous popularities in the past couple of years, along with the whole sense of machine learning, along the whole sense of big data, unstructured data. We started our research of using alternative data sources almost, say, 14, 15 years ago, along with machine learning. And I have to say this, at the time, we got very little interest. Right? So before 2007, I would say, if you talk about machine learning, that's not a popular word. That was a bad word. That was perceived as data mining, overfitting. That's all bad. It's being perceived as black boxes. The asset owners, so when you talk about the pension funds, endowments, sovereign wealth funds, they have almost no interest, and very few managers will also have interest. The vast majority of quant funds at the time were the conventional value momentum, multi-factor models. Actually, you didn't need to do that much of machine learning because your traditional value momentum factors, they were doing very well, and they were very transparent. So if the simple things work very well, and of course there wasn't much of a motivation to do anything all that different. Right, so of course, as we elaborated in some of these underlying white papers, we're saying everything has changed in a very profound way, especially after 2007, 2008, and 2009, and now it's all very different. Right, so we wrote our first research paper using news, sentiment. At the time, we partnered with a firm called Ravenpack. We're still using their data on news, sentiment, in stock selection, again, almost 10 years ago. At the time, again, we work out reasonably well in the sort of a medium horizon. Roughly speaking, is about a month horizon. Now, of course, if you're still extending to about beyond a month, the conventional news sentiment, it doesn't work so well. It doesn't quite survive transaction costs, but still works reasonably well if you have a shorter horizon, about a day, a week type of things. Right? So the argument is how can we do this rather than using the conventional off-the-shelf solutions? Can we do this in a different way? So we started, the first task is let's talk about a little bit about the EDGAR filing, which is a standard SEC filings for US corporates. We do the same thing for many other countries. And the classic example would be any countries, of course, obvious example would be any country using English languages. Right? So Canada, UK, Australia, you can do similar things. But the EDGAR filing has a very long history in the US, going back almost 20 years. And this is, again, a chart maybe not so easy to see, but this shows the number of corporate filings per day in the SEC database has grown, of course, exponentially. Now you have about 5,000 filings per day. Right, so I don't know how you can actually, not even mentioning about reading the 5,000 filings every day, just manually downloading the filings from the database is almost impossible. Right, so there are many different kinds of forms, and most well-known one, of course, is 10K, 10Qs. The 10K is you can see that as an annual filing, similar to the annual reports filed by the companies, and the 10Q, of course, similar to, in a slightly less context, but mostly about quarterly filings. And both the Ks and Qs, of course, follow very strong seasonal patterns. Because most companies have a December year end, that's why you're seeing there was a spike almost around February, March. There was a little bit of delay after fiscal year end. Around the financial crisis, as we have the Reg FDs and we have various changes in regulations, there was a massive spike in filings. And the same thing for the Qs. Again, using my personal background, I was a fundamental analyst. 20 years ago, I have to admit with gold is I never really read any 10K or 10Qs with enough of details, right? So I don't know how many people actually read them, because most of the financial data were available weeks before the filing, right? So you think about in the press releases, which came out normally first, the company already released a vast majority of the financial statements. And along with a supplemental data pack from the companies, you already know most of the numbers weeks or even months before the Ks and Qs. Right? So in the 10Ks and 10Qs, you probably read a little bit about the MD&A section, which is, again, company talk a little bit about their strategies. But later on, what I would elaborate is one, even if you actually read the Ks and Qs, it's highly unlikely you're going to find the most useful information, because we're looking for something that is very different. Whereas the 10Ks and 10Qs were mostly written for many sections, including the classic section is called the risk factor section. And this is probably the least read section. I don't even know anybody actually read them. When I talk to, again, I'll say our client base covers probably 95% of the largest asset managers, or whether they quant fundamentals globally. And I'll say less than 0.1% of people I talk to, they will say we actually occasionally read the risk factors. And they are primarily the distress and the turnaround type of specialists. They do focus on that section. And this is entirely different from the quants talk about risk factors. These are the risk factors when companies talk about the potential risk to their businesses, anything like environmental impact and product defect and labor dispute or alien attacks. Actually, there is no alien attacks. But it can be anything, right? So it's very generic, it's very broad. Mostly written by the corporate legal counsels, the internal auditors. It's not very exciting, right? So even if you read it, again, as I will show you later, it's unlikely you're going to find anything useful. So to do this, however, not only you need to look at the more exciting part, which is natural language processing, machine learning, The more boring part, however, plays an even bigger role, which is how actually we scrape the data on a daily or even higher frequency. We do this intraday. How do we actually map this to the company's identifiers going back in time, 20 years, which is again also not easy. How do we actually segment all the different sections and the keywords and do our NLP processing? So it's mostly, initially it's more about technology, I would say, than computer algorithms. So this is sort of the basic structures, how we do scriptings, and using the index files, putting them, matching to the takers, and we will divide the text sections into the small elements that we want to use. And you cannot just store the data in a conventional relational databases, which we've been using for 20 years. Again, I learned Oracle when I was in college back in the early 90s. Well, again, as Jonathan said, I may not look as old, but I've been in the business for a long time. You cannot use a relational database to process most of the unstructured data because it's very slow. Right? So you need to have a distributed parallel computing framework to compute this in real time. I'll show you one example. Right? So this is, again, a classic example of the various sections in the 10Ks and in the 10Qs. And this is probably the most interesting part. So this is the average number of words in the typical 10K over the past 20 years. It has grown exponentially. Now, on average, there are 150,000 words in the typical 10Ks. That's probably about, if you print it using the typical font size, it's probably around 700-800 pages long. So this is mostly legal words, not very exciting. So again, if you're trying to cover, even as a fundamental guy, you cover 20 companies, and this will be a tremendous amount of reading for you to do if you're actually trying to read it manually for the Ks and Qs. One example is just how slow it can be, right? So this is a typical word clouds. So the most frequent words appear in the risk factors versus in the market risk. Market risk is very obvious when companies talk about the market impact, interest rate, and so on and so forth. So it's more obvious. Well, if you look at the risk factors, there's anything like adverse effect and products and liabilities and so on and so forth. So producing a simple word clouds, just using all the companies, using entire history in itself, will easily take you a few days of computing on your typical desktop, right? So this is, again, why we need the parallel processing, because word computing is very slow. All right, so now let's get into something a little bit more interesting, right? So this is not about sentiment or news sentiment analysis, which the vast majority of the news analytics has been done, but we start from the basics, right? So let's look at the more conventional way when we have processing about textual information, which is about sentiment, right? So it can be as simple as counting for positive, negative words. And the classic starting point for most sentiment analysis is the Harvard Psychology Dictionary, which is not entirely designed for finance, because what we consider as positive versus negative in finance, it might be entirely different from in the conventional conversational type of context. Right, so you have to adapt it into the finance, which of course the couple of academic papers that we can start with. We also did it on our own, so we're mapping this. Again, this is a more conventional way, mostly manually. You map into positive, negative words. Then you train your computer algorithm by counting for the net sentiment, which is normally, again, the positive versus the negative words. So this is conventional, and this is the average of our companies over time. And you can see for most sections on average are mostly negative. So this is the nature of the filings. Right? So the filings is not about to tell you something more exciting. It's more about downside hedges. We told you these are the risks we may potentially face. So if anything goes wrong, don't come back and sue the companies and blame us. And this is mostly as a downward hedges. Right? So most of the words you see are mostly negative. And this is, again, nothing surprising. All right, so let's go through the conventional sentiment. You can see, again, the number of word counts spiked really anytime we have a crisis. Right? So the late 90s, the 2009 crisis, you see there's a massive increase in wordings because companies talk about the impact of the financial crisis. The sentiment, generally speaking, plunge in the crisis mode, but on average is some sort of constant numbers slightly negative. If you do the conventional sentiment analysis, so say, it does give you some intuitive results, sometimes also give you some counterintuitive information, right? So this is sort of a classic sentiment, which is counting for the performance of the positive So this is, again, in a conventional new sentiment analysis. You do this for both positive words, and you do the same thing for negative words because results are not entirely the same, although they are very similar. So this is a section where we do the conventional counting for the positive sentiments. Right? So the classic section is called FSS, financial statements and supplementals. If you have a mostly positive numbers and positive words, and generally speaking, the more positive results leading to a better Sharpe ratio. This is, again, everything is sharp, adjusting for risk. If you do this as a typical monthly backtesting, again, a typical backtesting we're using something we call information coefficient. This is in the conventional quant words. We're just computing for the correlation of our signal. In this case, is a percentage of positive words versus the forward and actual month returns. And you can see the performance is okay, right? So on average, you have about 1% positive correlations. Again, 1% may not sound a lot, but if you do this consistently, this is actually not too bad. Your conventional value momentum actually doesn't do much better than this. And actually, other than the period of temporary underperformance around the early 2000s, the recent year performance actually beating your conventional value momentum reasonably well. Right? So nothing really fancy, just conventional sentiment. Generally speaking, it does okay, but some sections in the business section actually produce counterintuitive results. Right? So one company being more conservative in the general business descriptions actually leading to a positive rather than a negative returns in the future. So again, some more counterintuitive. Then we can flip the sign. We'll look at the negative words or negative sentiment again. So in some occasions, you see a very sort of a counterintuitive result. Sometimes you see a positive. The other one, the previous one was positive. This one is on negative words. So in this case, you see a very intuitive results. In some occasions, you see some counterintuitive results. We did not flip the sign. So if you have a negative average performance, this is about negative sentiments. Of course, this is fairly intuitive. So this is a conventional way looking at a sentiment that we don't use. Now we're getting into something more interesting. Right? So this is motivated by a paper by Lauren Cohen from Harvard. This is one of my favorite papers. So the idea or the title is called lazy prices. Right? So a very interesting idea. So what Cohen argues is human natures, we are lazy. Right? So lazy in the sense is anything of recurrent natures. So think about 10Ks and 10Qs and press releases, the Fed minutes, and also your personal annual reviews, your resumes. Right, so actually, I run this for my personal resume. I have not updated for 10 years. But if I took out the old ones, I run a simple, you can think of this as word correlation. Right, so I look at the correlation of my resumes from one to the other iterations. They are about 95% correlated. Right, so anything of recurrent natures, what almost nobody would do is nobody would start from scratch. So how many times you're starting from scratch and writing a new resume? Almost never, other than the first time. Almost no company would start from scratch of writing a new 10Ks and 10Qs and annual reports. What almost everybody would do is you take what you did last time and you make some changes. Right? So the numbers may be different. We don't care about numbers. It's more about the word correlations. So the numbers may be different. You may add in a new section. You may delete a section. But it's very similar. So the language structure is very similar from one period to another ones. If you do this, again, as I said, is a word. Think about this as a word correlation. For most companies, most of the times, most of the documents, you do the same thing for Fed minutes. It's all about 80-90% positively correlated. Right, so most of the time, it's very similar in terms of language structure. But once in a while, of course, it changes. Right, so some companies, at a given point in time, it may jump from positive 80% into negative. And this is where it becomes interesting, right? So this is normally means when company foresees some sort of troubles. Lawsuits and product defect and labor dispute, this is generally speaking non-public, right? So when you see some troubles, you talk to your legal counsel, you say, well, I'm sort of seeing this may impact my business in the future. And your counsel will say, well, you're adding some new languages. In the section in particular, again, as I said, nobody really reads. Classic example in the risk factors. So if you don't get a lawsuit, you have a downside hedge. If you don't, then nobody read it anyways. So this is, again, a classic example. Right? So we cherry pick one example. This is American Express. So the first quarter of 2014, they add a new section, something called substantially increasingly intense competition for partner relationships, risks surrounding the airline industry. So again, I don't really know what that means, but unless you actually read this, not only you read this section, but you actually compare with the previous ones, and you know there's a new section, which is highly unlikely if you do this manually. And this actually means the company foresees some sort of a trouble around the airline industry, and they got a lawsuits, and later on you talk about ongoing legal proceedings can cause substantial monetary and reputational damages. Right, so what we find is whenever there's some sort of a new risk, new languages and new paragraphs being added to the sections, especially in the risk factors, it does tend to lead to negative returns, some sort of a downside risk. It tend to be fairly accurate, but more importantly, this is a very long lead time. So the lead time is about 3 to 6 months if you think about the Qs. If you think about the annual reports, is more about 6 to 9 months. So fairly long leading time into downside risk. So when you're looking for the classic shorts or avoiding the blow-ups, this is probably one of the very few really good examples. All right, so this is how we do the typical backtesting. The way we measure the word difference is so we use a sort of a classic distance factors. The bigger the distance or the bigger the numbers means, the higher the correlation, so the opposite of way of you thinking, right? So normally you think about risk factors, for example, these are the guys with the biggest changes from quarter over quarter. When you look at about 10 Qs, you can sort of see again, in the risk factors, doesn't matter how you measure the difference, whether you look at returns or you look at Sharpe ratios, there is a very strong performance monotonically, but it actually doesn't really matter which section you look at it. This is one of the most consistent. So most sectors and most sections, you kind of see something very similar. And this is actually something far better than the conventional sentiment, actually far easier. You don't need to worry about how you actually define positive versus negative. There's actually something leading to a far better return profiles. All right, so this is again, when you look at the time series performance, again, all we find trying to say is this is also far more consistent than we showed you earlier than the sentiment. In recent years, we haven't really seen much of a decay. And this is something we call information decay into the future. Along the x-axis, meaning this is a correlation of your signal versus next 1 month's return, 2 months. The third, this is not cumulative. So the first and second, the third, and going forward, you can see using the 10Qs, the performance lasts to at least about a half a year. In some occasions, using risk factors. In another occasion, you can see it can last for about a year. So fairly long-term predictions, low turnovers, as we're using mostly of the quarterly and annual filings. So something probably quite interesting. All right. The other one we find quite interesting is again, switching gear a little bit from the first one, we'll look at the sentiment. Right, so the second one, we'll look at the word structures, all the changes in the word correlations. The third one we'll look at is something also quite interesting. And this is talking about the percentage. If you take classic filings, of course, one, you can present the information in the sense of data and tables and charts. You can also talk about it in a sort of a conventional textual descriptions. Right, so you have the two choices, and what we want to understand is whether it makes any difference when a company is mostly in the talking mode or the company mostly presenting the hard numbers. Right, so the classic story was, when I think about back into my business schools, right, so we have a classic course which is about company evaluation. Right, so when you do the evaluation, most teams will do a DCF type of evaluations, and will present how you do your assumptions, how you value the company, and so on and so forth. Then you talk a little bit about the company generic strategies and some more descriptive information. Right, so this is most teams do, and of course we also have one team, we know none of them know how to do evaluation, they don't work very hard, so they will spend most of the presentations in a talking mode rather than showing the numbers. Right, so the argument or the hypothesis was, if you have the good number to show, maybe you don't really need to talk too much. And if you don't have great numbers to show, if your financial performance is not that particularly strong, then maybe you want to talk about the future. Right? So when you're mostly talking about the futures versus it's just telling you what you have done in the past, right? So this means something very different. Right, so that's a very simple example. We're just counting for the ratios of numbers, or numeric versus the textual informations. And again, you see something very interesting. So the higher the percentage of numbers in almost every single section, but in particular in the section, so MD&A section, which is again, one company mostly talking about the financial performance. So this is a classic example. If you haven't done so well, you need to explain it, why you didn't do so well, and you want to talk about the futures. Right, so this is a classic example. The more numbers you have, generally speaking, the better the returns tend to be going forward. So this is again something a little unconventional compared to the traditional sentiment analysis. Then we can also go on a little deeper. So this is again going from the NLP, we're trying to combine with machine learning, because in a conventional way, the importance of the sentiment of each word is being defined by some sort of a manual process. So you define, when I talk about earnings, beating expectations, and this is very positive, I say, I miss earnings, that's very negative. But this is, again, somewhat arbitrary. So what you want to understand in this exercise is, can we train the machine trying to quantify the importance of each keywords? So this, again, is mostly part of the training process. So you're looking at the keywords for the companies in the filings. Then you compute, in the simple senses, what keywords potentially lead to higher or versus lower returns into the future. So this, again, this is thinking about using machine learning combined with sort of an NLP algorithm. Actually, if you think about the Ravenpack or the Thomson Reuters type of new sentiment, I know one of my colleagues from Thomson Reuters talking about it at another session. So this is, again, going back into the traditional session. There is a bit of a sense of overfitting because you have to divide your samples properly in sample, out of sample. But this is, again, one more way you can get some additional advantage, which is combine machine learning with the keyword learning process. All right, so this is, again, one of the models that we can eventually build. So we call it systematic profiling, EDGAR composite, and we call it spec model. So this is a model about combining the few different things we have discussed so far. So using the word sentiment, using the word distance, which is about computing the correlations. Then we talk about using the numeric versus data. We talk about using machine learning, training, and predicting the importance of each keywords. Then we combine them together in a sort of a fairly simple and straightforward way. We call it our composite model or composite alpha. So it does deliver into, again, as I said, it's fairly consistent, both in terms of information coefficient. This is a correlation between your predictions and the future returns, but also in the sense of long-short portfolio returns, although in reality, we don't really trade just simple long-short portfolios. It does lead into a fairly monotonic pattern, although most of the performance come from the short side. So this, again, is more about, think about the risk factors and the distance I talked about a little earlier. I think this is, again, the payout pattern is somewhat asymmetric, whereas it's more about identifying the companies with the potential troubles ahead, rather than just buying the winners, although the payout pattern does appear to be somewhat reasonably monotonic. The turnover is fairly decent, other than we using a hybrid of a quarterly and annual filings. So there is almost like every bit of a spike. Every quarter, every year, you have a bigger spike. But other than that, the average turnover, this is a completely unconstrained turnover for a classic long-short portfolio. It's really just about 20%. And this is more or less in line with more of a price momentum, slightly higher than the value signal, but much lower than any of the conventional type of factors. So fairly decent of a turnover, but also very reasonable IC decay profile. So the returns, predictions, this is, again, not cumulative. This is about predictions about next 1 month, the second month, the third, all the way to the 12th month returns into the future. So again, this appears to be fairly consistent. All right. So last page I want to talk about is well, this is all great, all sounds interesting, and all sounds great. But if this is just a proxy or linear combination of all the other factors, then it's not really useful, right? So we're just computing for something quickly and simple. The first one is computing for the correlation of our signal with all of your traditional factors. We have a factor library with about over 400 factors. So this is more like a proxy for classic styles: value, earnings revision, price momentum. 1 month reversal as a proxy for mean reversal, state-out type of strategy. Earnings growth, ROE, market cap. This is more like the last 2 columns more like a proxy for risk. So we have a size and we have a volatility. And you can sort of see the correlation is around or below 10% in most occasions. So that now appears to be just a simple linear combination of the other factors. We can easily combine the news or the texture mining signal with your conventional value, momentum type of strategies. You can see there's a across-the-board improvement regardless which investment style you added on top of it. All right, so this is sort of the main part of my talk. With that, I will open up to questions.
Thank you for the talk. I like the approach. However, it seems to me that there's a substantial work left to just even get to these kinds of results.
Yeah.
And so if you could speak to, what kind of team it takes to even get the basic infrastructure before you can even get some sort of sentiment off of one word.
Right, so you're absolutely right. So the infrastructure, of course, is a far heavier investment. I'm sure Quantobian know this is just as well. Right, so it took us, so again, it's just as a little background is most of my team came from Deutsche Bank about 6 or 7 months ago. So it took us about 4 months to rebuild the infrastructure. It's not just about the typical 4 months, right? So we've been doing this for many, many years. And the youngest member in the team has been working with us for about 5 years. So we have done this for a long time. So we were able to redesign the whole system entirely in a very short period of time. And this texture mining is only a small fraction of our overall design of our technology. So this again is more about to design this. Actually, the project started from a very interesting experiment a few months ago when we do our academic literature review. Right? So we all do, the first research project we do almost all the time is we want to see how other people have done it in the past. Right? So the conventional academic literature review is you go to ssn.com, you go to various academic databases, you're doing keyword searches. Right, so what we want to see is well, how can we possibly automate this process? When you think about it, it's almost the same as the project we have here. So one, you need a web scraping tools. You want to download all the academic papers coming out in real time from various sources automatically. You put it into a database. Then you have a training process which is saying, how do I actually identify the papers of interest to me and by the very subject and by the relevance. So this is again an NLP algorithm. Once you produce it, in that occasion it's much simpler just producing the papers that you want to read. So that's actually was the original infrastructure we designed it. And of course it was much simpler, so it took us about almost like a month. Then we said, how can we actually leverage this and to do something more useful? So this will be naturally the second choice, which is texture mining of the corporate filings. Then currently we're also working on the next step, which is how to actually extend this from single companies into macro. So when you think about futures and similar kind of things. So we have done this for about 20 different central banks, right? So central banks, we can do exactly the same analysis. We download everything as press releases, Fed minutes, and every single filings or every single service from the Fed, from ECB, from the PBOC, from BOJ, so all the major central banks. Then we're kind of trying to do the same thing. Obviously, it's far easier to do anything with the English language because NLP is fairly well developed. But as you get into the other languages, it becomes substantially more difficult unless it's being pre-translated into English.
And how large is the team?
So we have a team of 9 people now, but we have a few more coming joining us. Actually, any of you looking for a job, so we're definitely still looking for talents. A little bit of promotion.
Thank you for the talk. I was looking at investment banks' products that they're selling and they have to file. Do you guys look into those? For example, the selling of the products, Goldman Sachs has certain ETFs that they post. They're all different in structure, and so I don't know if you guys have worked on that.
Yeah, so currently, this is again, once you have the infrastructure, it would be fairly straightforward or say fairly obvious to extend it to other textual information. So currently what we're doing is we also doing the same thing for call transcripts from the sort of conference calls. We're doing the same thing, as I said, is for central bank statements. We're doing the same thing for other filings beyond the 10Ks and 10Qs. One thing, for example, we were able to find was very interesting was more related to retail industrial companies. So one specific sections in the 10Ks is called inventory purchase agreement. So this again, if you know the accounting rules, it's something very interesting, right? So this is one mostly thing is when you're buying inventory from your suppliers, you can of course spend the money and buy it and recognize it on your income statement balance sheet directly, or you can say, well, I'm signing off agreement, so I'm going to buy this from you, but I don't want to buy this now. There's sort of two sets of hypotheses. One of the things is if you want to make your inventory turnover appears to be more efficient than it really is, you delay your buying of inventories. So this is again something of somewhat related to manipulations. But the multiple things, of course, you can do. Doesn't have to be a single company. It can be on the ETFs and all the other filing data.
Hi, I just had a question about your workflow especially the web scraping part. Do you use any proprietary? Is it in-house or you use open source? Like, can you talk a little bit more about your tools that you use for web scraping?
Yeah. So the web scraping is completely developed in-house. So actually, almost the entire of our technology infrastructure is entirely developed in-house. And this is actually something quite interesting. So I delivered a similar talk at another quant conference in London a couple of weeks ago. When we talk about the conventional technology infrastructures at a large organization, I worked through 5 different banks in my 20 years of career. Every single bank we were required to store all the data on the bank-owned data center, and we also, of course, have to compute on the bank-owned data center. So you know this, our large organizations tend to buy the hardwares and do all the computings. But now, of course, now it's very different with development in clouds, and actually many of the tools are available as open sources. You don't have to just completely using open sources, but you can use the open source libraries. You take the source code and you can customize it. You can develop something of useful to you.
So I see that you have used S3 as an AWS to leverage this workflow. So how feasible it is for cost-wise, infrastructure cost-wise, for startups to follow your own workflow? Because you obviously have better funding, or banks have better funding to do this. Yeah. But for, let's say, small startups, how feasible is this workflow?
You know, I would say 2-3 years ago would be highly infeasible. Now what I would say is completely different, right? So you know this again, no, this means only a few years ago. Again, mostly was dominated by corporate data centers. And even the cloud providers at the time was still relatively expensive. Now, of course, the cost of storage and cost of computing has declined massively. So I'll show you one example, right? So one example was in our global stock selection model using machine learnings, we run a horse race of popular different algorithms. One of them, of course, is random forest. Not the best one, but has been around for a long time, is well known for being very slow. Right? So performance was decent, but very, very slow because you're building thousands of these submodels. And this is very similar to the text processing because you're doing this for thousands of documents at the same time. So even one processing takes you a few seconds. You combine them, you average them, that's easily a few hours. So for that simulation back at the big banks, we were only able to do it for US equities, and because to do it globally would take us way too long. For US equities, for a single period on Linux Blades computing took us about 2 hours. So if you think about the backtesting, 30 years times 12 months times 2 hours, that's about a month of nonstop computing. Now, of course, it's entirely different. We do this parallel, we do this on the clouds. We can run as many servers as we want. Only took us, a global backtesting took us less than 2 hours. So that's the difference of you end up waiting for half a year. Of course, by the time it's done, it's all over. Now it's just, you can scale up even more than 2 hours if you really want to, but it makes almost no difference. And the cost is very minimal because the per unit of storage and per unit of computing is actually going down every year.
Hello. Basically about like the text infrastructure. So I have seen that basically all your keywords is single word. have you seen consider about like word pairs, like or even like some like even like group pairs, like how that's important and how that will affect the overall result, and also about like for example verb, like about the future tense and the past tense. So have you your group like maybe just trimmed out words into word roots, and then make the model or whatever. What's basically the idea for those? How do you deal with those parts?
Yeah, no, the word groups are very important. Actually, the distance among keywords is very important in certain occasions. So going back to my earlier example about using a similar system to identifying but also quantifying academic research papers. In that occasion, for example, how do I know if a paper is talking about stock return prediction versus, let's say, global macro strategy? So of course, not only if a paper talk about firm and returns and predictions, if you talk about predicting stock return in the same word group, then of course it's far more relevant than the distance among the three keywords spread it out in a different part of the paper, right? So the distance is very important. We normally strip out of all the different tenses into one keyword. So we haven't figured out, at least we haven't tried to figure out the differences of different ways of describing the same word. But this is like definitely only, I'll say, scratching the surface of far more work you can do.
Did you find these signals predictive of stock market volatility events like the stock market crash?
Right, so that will be more on the market level. On the market level, we haven't. So one, you can do it in two ways. So one is obviously you're aggregating this bottom up. You have this sort of in each one of the matrices I talked about earlier. I wanted to show you the return prediction context. They predict risk equally well. In some occasions, they actually predict risk better than returns. So one, you can aggregate this from bottom-up basis, and you do this. The other one, of course, is you can also do the same processing on the top-down level. That will be more on the central bank statements, on the news type of arguments, which we have done in a few ways, right? So one is using the headline, what we say, using the mainstream media, right? So this is about media sentiment or media analysis. It's actually quite interesting. If you do this, one of the measures we compute is called the macro uncertainty, looking for mostly just the keywords. When the mainstream media talk about elections, immigrations, and economic policy, tax policy, and so on and so forth, that's a proxy for media, or what we call the macro uncertainty. Based on that measure, of course, for the US market, November around the election was all-time high. For UK, of course, with the Brexit, it was all-time high. So that basically means the media think there's a high amount of uncertainty around everything. And you can do the same thing, something we call the average consumer uncertainty, which is based on Google Trends, right? So you do the same keywords using Google Trends. For the average Americans, average Brits, so you find something entirely different. That's close to all-time low. The average American think they couldn't be any better, or the average consumers in most countries think there's actually there is nothing wrong and it couldn't be any better. The correlation of the media, what the media thinks versus the average consumer thinks, is almost negatively correlated. Right, so this is again, they both predict market crashes and market returns, but in a very different fashion. So this is again something, but even if you do the same thing, right? So we do the same, we compare our sentiment versus new sentiment. So when the reporter is writing a story, same stories about Apple and IBM, they almost uncorrelated. So it's very different from what the company's own filing versus what the media thinks about the companies, and they are entirely different.
I have another question. You said you were looking at the inventory for commodity companies, and how I want to know the predictive strength of the inventory and other entries in the financial statements and futures data, because I think you could get up to 3 contracts per ton of iron or et cetera. And you don't do international companies, so I don't know if most large corporations of Vail, stuff like that, are international Brazilian iron companies.
No, actually, this is, again, just as a little background, this is only a small, tiny fraction of what we do. So we apologize if I do a little bit of a promotion. So we sell side research, right? So we do global equities. So every single stock, we cover 11,000 stocks globally. We do global on asset classes, global macro research. So this is again a small fraction. We have a separate models for commodities and retails and industrials. We are a big fan of big data. We've been doing this for many, many years. We have a license with about 40 different vendors. We're using anything from satellite images to credit card payments to our own text minings. We also use about half a dozen of news providers from various sources. So yes, so in that occasion, of course, is when we think about inventories, that's more for retail industrial companies, but we have a separate data sources covering commodities and energy companies, but also the commodities themselves.
Okay, great. Thanks. I think we're just about on time. So Yin, thank you very much for that incredible talk.
Thank you.